So I truly understand that nobody likes to admit to their failures. Really, I get it. I really do. But if we can kind of be critical of our own actions, you know, as we kind of proceed through life and kind of reflect upon the mistakes that we've made through life, and you're able to take lessons learned from those mistakes and provide those lessons to folks that are coming up through the ranks, right, that might not know the wiser, I really think there's a lot of inherent value. Guys, it's going to be my top 10 blunders that I've had through my investing career, guys, so please enjoy. If this is your first time tuning into the Independent Investor channel, subscribe to the channel. We talk about empowering individual investors to take control of their financial future and invest for themselves. Eliminate the middleman, and it's going to make all the difference going forward in the future, guys. So let's get right into it. The number one mistake that I've made in my history that's really affected my compounding effect is not getting started early enough, okay? And I talk all the time about being invested when I was young, but man alive, if I had this information, I would have been powerful, right? And just tuning into the YouTube channel, my channel, and catching a 10 or a 15-minute piece. I'm trying to shorten them up a little bit for you guys, but it's my favorite topic, and I love helping people. So it's hard for me to do a 6-minute video on my favorite topic, all right? That's my rant, all right? But if you're listening, and you're 18, 19, 20 years old, 21 years old, a lot of folks my age love to help people younger, man, coming up through. We would love to see you guys sink your teeth into some success early, because quite frankly, you guys are going to be the ones that lead this country, all right? And if you ignore the importance of financial security going forward, it's just going to create that division between the haves and the have-nots, right? So if you guys can really resonate with the importance of starting early in your life, you're going to be so much more ahead of the game. And it may not make all the sense in the world to you, but if it's something that somebody says investing is something that you have to do, just do it. Just do it. Do not wait. Do it and make those validations later on in life, man. You'll be glad that you did. Number two kind of is related to number one in that starting early is just as important as starting correctly. All right, now I cannot stress this enough. I started about as incorrectly as you can. I've done about every method incorrectly until I came into self-directed investing about 7 years ago. That's it. All right, now through self-directed investing, I've accumulated a significant amount of wealth because I have the ability to compare how my accounts grew when I was attached to a financial planner, and now I compare the growth that I'm realizing being attached to the New York Stock Exchange directly. It's just me and them. There's no middleman in between, right? So the idea being, and I think you guys can really use your imagination, but I do provide tools on my Facebook group, the compounding calculator that takes into account expenses within an account will really give you that validation to know that if you started correctly and you were able to eliminate fees and wealth preserve in an account, that would be the closest to correctly starting in the market, and to do it as early as you can. So starting correctly. I talk about it all the time on this channel, and I will continue to repeat it through the life of the channel to help new investors, because they may not catch it on the first time, they may not catch it on the 7th time, but if they catch it on the 13th time that I say it, then so be it. We are making a difference, and we are empowering people. Number three, not tax protecting, all right? First investment I ever made, I invested in 3 or 4 mutual funds. Weren't tax protected, they were in a brokerage account. Wrong way to invest. Had no idea what the expenses were of the mutual funds, but they were not tax protected. And I underappreciated at that age when I did that. I think I was in my late teens, honestly, around my 20s, and invested in mutual funds. That was the very first thing. It was the only thing. Hell, we didn't even have index funds or ETFs when I was young. We didn't have those options. And stock investing was made out to be like the haunted house. So that was just a big faux pas. It was someplace that you just did not go. So what other option do you have? I knew the importance of investing at that time. I knew about the rule of 72, and I knew about compounding interest. So mutual funds just seemed like the way to go, right? So not tax protecting, right? So if you're out there listening, what does this mean for me? Is there something that Ryan offers through advice to allow for tax protection? Absolutely. If you've paid attention through my catalog of going on 150 videos, I talk about it all the time. I give you the very best option that I know of to help you guys tax protect your hard-earned dollars, all right? The next thing, number 4 on my top 10 blunders is overexposure, all right? I've been an aspiring young entrepreneur at heart my whole life, no doubt. And that passion and fire keeps me going, all right? Unfortunately, as a young person, I thought that I could just basically live on fumes, right? And take my entire net worth, which at the time wasn't very much, and just devote it all to the stock market, all right? And you learn really, really quick, if you guys haven't learned over the last couple weeks, that stocks, yes, go up, but when they go down hard, all right? So the markets go up and they go down. That's just part of the gig, all right? But if you overexpose yourself to the stock market, you don't have any validation or any type of sleep easy money that I talk about all the time. You don't even have money for, everyday living expenses. And I'm talking about even some luxury items too, man. Throw vacations into that category. But the idea being that you only devote enough dollars to the stock market that you can still remain comfortable on this side of the house. Overexposure, one of the top 10 blunders that I've had in my career. Number 5, not having a realistic goal. And I don't know how many of you guys out there, man, I talk to a lot of millennials. I work with a lot of millennials at work. And I can't believe how smart you guys are. I give this generation a lot of credit. A lot of people want to beat you guys up, and I think that's really unfair. I mean, you're just dealing with the cards that you've been dealt. And what you've been dealt is opportunity, okay? I mean, you guys, I know millennials that are coming up that are seizing that opportunity and they're making themselves wealthy, and I'm all about it. I am all about it. Somebody who goes from nothing to something, that is in essence the American dream, and I am all about it, and I'll do whatever I can do to support those initiatives. But you have to have a realistic goal. And if you are able in your younger 20s or mid 20s or late 20s to sit down, if you're married, great. If you're not and you're single, look the hell in the mirror and say, God, Ryan talked about a realistic financial goal. Because when I was in my early 20s, I wanted to be a millionaire, okay? That is not a realistic financial goal, so you want to get that out of your mind. Do I want to be financially secure in my future? Yes. Do I want to retire with some wealth? Yes. Now we look at how we strategically get there, but you have to have a realistic goal, because once the volatility kicks into the stock market, you're going to reflect back on your financial goal, and that financial goal is going to validate why, in fact, you are making the decisions now in the short term to support your long-term realistic goal, all right? Number 6, one of my biggest blunders that I've ever made in my life. Referentially, if I think back of really one of the ones that really makes me cringe. Number 6, in one word, selling. Selling, okay? I get asked this all the time. What's the right time to sell a stock? Never. Just don't sell the stock, okay? I'm trying to pass the most credible information, and a lot of people are going to say, oh, come on, Ryan, geez Louise, you got to take profits every now and then. Not really. As a young person, your goal shouldn't be to make 20, 30, 40, 50%. Your goal should be to make thousands of percent, right? Because you're underestimating the cumulative effect on the dividends paid quarterly that compound on themselves as you own the stock going forward, all right? So to underestimate the value of just accumulating shares, right, and overemphasizing the value of when to sell, just eliminate it altogether. You're going to make your investing life so much easier if you just say, you know what, Ryan talked about never selling. If I buy a stock like Disney, am I just as happy to buy the stock in Disney tomorrow, own it next month, own it next year, or own it 10 years down the line, guys? Sit back for a second and imagine life without the Disney parks. It's impossible. That's how big of a moat Disney has, right? So that's a name that we want to invest in. Apple, same idea. Procter & Gamble, Johnson & Johnson. That's why I offer all these blue chips, because we cannot imagine our life without these. They are embedded. They have huge moats, right? We have to have these products when we do our laundry, or we change our kids' diapers, right? Or we go on vacation to the Disney parks, right? It has to resonate with you. But selling is the #1 mistake I've ever made. And usually it's been I sell early, or perhaps maybe I sell too late. My goal should have been, and it should be as early as you can, to accumulate share base. That's it. Accumulate shares. Don't worry about the dollar amount. Don't pay any attention. If you have to put a piece of paper on your computer screen to cover up the dollar amount, and you look specifically at the share accumulation that you have, and your dividend reinvesting in that program, and you're accumulating shares within that account, that should be your focus. How many shares can I accumulate over the course of my life when I retire? Then pull the sheet of paper away and be surprised, right, at how much you've accumulated over your life, because you haven't been tempted to tinker. All right. The #7 top 10 blunder that I have had in my life, unfortunately for me, which is a lot of the root of why I came out with the Independent Investor channel, is trusting. All right. Trusting somebody other than myself. Now, the ironic part about this is you guys are going to have to instill a little bit of trust in me. How do I earn that trust? Very simple. I don't charge you anything for the message, all right? I don't put a tip jar in front of my YouTube channel, all right? All I do is ask for your support and subscription, and ask for your support and referral. That's not too much to ask. I do put ad revenue capability on my channel because I really want to get compensated for my time and the investment that I put into the channel. That's fair. But as far as this costing you anything to get this information, it costs you nothing, all right? And if I have not done my job in selling my credibility to you, then that's my deficiency, all right? But you have to trust no one other than yourself. You have to. If you trust yourself and you enter into a program that makes sense to you, then it makes sense to you. But when you go in and you sit down with a financial planner, they are going to try to sell you. They are all salesmen, all of them. I don't care. Argue with me. I invite financial planners to come onto my channel all the time. The one that came on and tried to argue with me, I buried him in the ground because they're wrong. They're wrong. There's no way that you can argue with this information. There's no fiduciary responsibility. So when you go in there and you trust somebody that is not bound to have your financial best interest in mind, you will lose. You will lose. And the only person that is worthwhile in this life to trust is yourself. That's it. That's it. That's why I talk all the time about empowering. Empowering is all about entrusting yourself with the simple steps to realize those financial goals going forward. We teach that on the channel. #8, timing the market. It's impossible. Don't try to do it. Buying the dips. There's a lot of misconception in the stock market in that you're going to sell and somehow wait for a sell-off. You're not going to do that. The second you think that you're going to time the market, it's going to go up. And that one time, that one decision that you make to miss out on that up instead of a perceived down or an anticipated down, you're going to miss out on that up. That's going to affect your compounding effect going forward. And it's going to affect it for years. So you want to stay the course and stay in the stock market through ups and downs, all right? You cannot time the market. Anybody who advocates for such is not teaching along sound investing fundamentals, all right? #9, the biggest mistake that I've made in my career is not diversifying, okay? Now, I talk to a lot of people, busy moms and dads out there, folks with careers that come up with false validations as to why they need to go up with a financial planner. Don't need to do that. Get rid of it. It's a way of the past. You do not have to invest that way at all. You can set these accounts up to be diversified right away. Indexing, and my favorite way is through exchange-traded funds. Those diversify you right away. So expose your dollars to the stock market in the S&P 500. You're getting a piece of all the companies. If you want a broader stock index, that's why I offer the VTI, which is the Vanguard's ETF for the total market index. That will also help you. That's exposed to 3,600 stocks. So it gives you that broad-based diversification right away. competitive rate of return with super, super low expense ratio in the account. Number 9, not diversified enough, all right? And single stock, guys, I don't care what you say. I'm gonna tell you right now, if you're looking to build an entirely stock portfolio without a baseline in way of a 401k or a TSP plan that gives you a fundamental base, you are not diversified. You are not. You cannot diversify a portfolio with single stock allocation. You can't do it, all right? Number 10, the most important message that I pass on my channel, the most important fundamental truth, if you took nothing else from this channel, is the importance of a term that I believe I've coined, and that is wealth preservation. More importantly, on how to wealth preserve within your account, all right? Your account is your bucket. Okay? And so many people have a bucket with holes on them. So when they try to invest and fill that bucket, it's coming out numerous holes in the bucket. All right? We want to try to provide you with a bucket free of holes. All right? Free of the middleman, free of somebody who's going to come in there and is going to take away those dollars over time, right? And just because you don't know about it doesn't mean that it's not happening, guys. It is. It's happening. So wealth preservation is the technique that we deploy to eliminate or drastically reduce fees within your investment account, guys. Hope you enjoyed my top 10 blunders from my perspective. These are all very real. These are all things over the last 25 years of investing in the stock market that I have experienced. If you paid attention to this message, avoid them at all cost, guys. Avoid them at all cost. If you can say, wow, Ryan's really kind of reaching back and providing what blunders to avoid, just avoid them and don't do them, guys. It'll help you so much more, and the message that I provide to you guys will mean more dollars in your pocket going forward. If you haven't subscribed to the channel, hit the subscribe button, share the message with out there and your guys' networks of friends, as I'm basing a lot of the success of this channel on referral alone, not necessarily through search, guys. You have to share it with your friends and family. If you feel like they need the information, they're looking to get involved and educate themselves up on the stock market, certainly share the message with them, man. Bring them to the channel. They can reach out to me directly. And my channel's not big enough right now, so I try to make myself as accessible as I can to my viewers. Leave your comments at the bottom of the video. Leave your blunders, please. Mistakes that you've made along the way. I will respond to those. It helps the community read through some of the other ones that perhaps I've missed on my top 10. Guys, thank you for tuning in to this top 10 blunders in my history of investing. Good luck in your investment future.